Number 2, diversification, which is worldwide diversification and diversification in asset classes with different correlations. If you or I or anybody else can forecast the future, we wouldn't need to diversify. We just buy the investment that's going to go up. It'd be easy, so easy. Would be unnecessary. In this next video, you're going to see this chart. You're welcome to pull it out. It's in your booklet, but you're going to see this chart. And the video is from the year 2006. We have the chart updated through 2016. 10 years. In fact, through that entire chart, the point is the same. It hasn't changed.
The author of Statistical Thinking for Managers and several other statistical and math-related books is also a PhD in mathematics. I asked Dr. R. Lyman Ott, is it possible for an equation to be developed that consistently predicts fund movement or market direction?
And the answer is no. I mean, resounding no. I think the evidence is overwhelming and abundant that such an equation does not exist, nor could it exist. And I'll take, first of all, a portfolio. And I think if you take active managers who you would think would have access to some equation if it existed, or somebody related to their companies would have access to it. Active managers consistently cannot beat the market. The data are overwhelming. Let's look at the market in more broad sense. There are various segments of the market, large cap, small cap. I think there's a great graph. It's a colored graph. If you look on the vertical column, it gives each year over 30 years. And in this column, you would get the asset class that performed the best. And going across in the horizontal, you have the very best asset class going to the worst among 8 asset classes, small cap, large cap, value. Each one of those asset classes is color coded. It looks like a Picasso. There are colors all over. If you looked at this column, which would be over the 31 years, if you were able to pick the asset class that was actually going to perform the best that year, the rates of return, the annualized rates of return would be phenomenal.
How phenomenal? Here's an example. If an equation existed that allowed you to pick the correct best performing asset category in advance every year for 33 years, the return would be a mind-boggling 36.24%. Therefore, a hypothetical investment of $1 million would have grown to a ludicrous $27 billion over the 33-year time period. The catch is, you need the clairvoyant formula to correctly predict the future.
Well, is anybody doing that? Absolutely not. So that's another way of looking at it, saying, is there an equation that could pick out the best asset class? Not what the Dow Jones or whatever, but what asset class around the world is going to perform the best. And again, the data are overwhelmingly against. And what it says is then you better diversify, because we don't know the formula and we don't know what's going to happen. And if I go back to just the idea that somebody could write an equation, some mathematician or whatever could write, I think it's preposterous. It's not just mathematics and economic, it's finance, it's technology, it's military, it's climate. All these things impact the market. And it would be saying that somehow we're able to predict the future and take into account all these random things that happen and impact the market. And I think that's just absolutely impossible.
So there is a lot of randomness in the future, and I was fortunate enough to eat dinner a couple of times at an advanced advisor conference with Dr. Lyman Ott and his wife. Very, very nice people. I saw one of his textbooks. You saw him at the beginning. It's like about that thick. I opened it up. I can't even begin to comprehend the formulas that he's written in those textbooks. It's like Japanese to me, you know, it's just no way. And if he tells me that you can't factor in randomness into a formula, I believe him. I believe him. So in this chart you'll see, and why we rebalance the portfolios, because you'll always see that sometimes the worst column in future years becomes the best, and the best becomes the worst, and you can't predict that in advance. U.S. small company minus 40, U.S. small company plus 71. International large, minus break even almost, then plus 69. U.S. small company, minus 27, and then plus 50. Minus 21 and minus 13 on international large, then plus 26 and plus 11. Minus 46 on international small, plus 48. And then U.S. small, minus 9 in 2015, and then plus 37 in 2016.